Morning, everyone. This is Ken Weber in New York, Weber Asset Management. It's March 18th, 2020. We're in the middle of some extreme volatility in the market. I'm here with my friend and partner, Jack Bowers, Chief Investment Strategist at Weber Asset Management. Jack is out in Reno, Nevada. Jack, obviously people are concerned about what's going on, and you and I both have lots of thoughts about what's happening. Why don't you give us a quick overview of your thoughts right now?
Sure. Well, we've seen a fairly deep and substantial correction, and a lot of stocks, especially in the leisure industry, that are selling off with a very large magnitude. I think if you look at this in the broad context, it is not like other bear markets in the sense that this is a temporary disruption. We have a lot of economic activity being canceled all at once, more than we've seen in any previous downturn or recession. But at the same time, it is all kind of a temporary 3-month situation where most of the things that are being canceled are being rescheduled in 3 months. And for companies that are furloughing employees, many are keeping them on the payroll, and some are even retaining their healthcare benefits with the idea that they'll just be calling everybody back in 3 months when the crisis is significantly over. So I don't think, while some measures like unemployment and other things will temporarily look a lot worse than what we have seen in the past, 3 months from now, we'll be well on our way to a recovery of sorts, unless there's some unforeseen circumstances. We've already seen that South Korea and China have successfully contained the virus, and while the Western cultures may not be able to do it quite as effectively, it's proven that it is possible at this point, and I would imagine that most countries will be on the same time cycle as China in terms of bringing people back to work and reopening schools and resuming a normal consumer environment.
Now, as we're talking, there's a news conference about what the government wants to do in terms of injecting massive amounts of the stimulus back into the economy. Just before we came on, the number that was thrown out was $1 trillion. So there's a bunch of plans that are going to be bandied back and forth between the Democrats and the Republicans. The House and the Senate are going to work things out. But it's very clear that both sides of the aisle realize we are up against the wall here. They cannot dilly-dally, and they've got to hunker down and work together to stimulate the economy. So we're good. We're happy to see that happen, Jack, I would assume.
Yeah, and I think that makes a lot of sense. You have a situation where maybe 20% of employees are without a paycheck for a few months, and you've got to do something to help those people through this temporary period. By the same token, $1 trillion is quite a bit less than was spent to help the economy get back on track after the financial crisis. And I think the reason it's quite a bit less is because we're only talking about something that has to get people through the next, say, 3 months or so.
Right. I mean, there are many scientists who say the disease could affect us for up to 6 months. That's one side of the equation. The other side is, at some point, they will announce some progress on the scientific side in terms of either a treatment that seems to be viable and or a vaccine that seems to be viable. And as you and I were talking just before we went on the air here, the stock market looks 6 months or 12 months ahead. And if they think there is a reasonable chance of a treatment or a vaccine out there, the stock market everybody wants to be the first back in on the good news. It's not going to wait for it to actually happen before the market shoots back up.
Yeah, I would agree. I think it's going to be a few months before we know how successful some of these modern biotech vaccines work. But some of them have already been proven with different coronaviruses in past animal studies, and the risk of these vaccines is very low compared with conventional vaccines. So it's totally reasonable to expect accelerated testing and accelerated deployment. It would not surprise me at all if 3 years from now, the world's population is largely either has natural immunity or is vaccinated. So I think if you take a 3-year view on this, it's hard to see where the global economy won't be back to where it was 6 months ago in some reasonable sense of the situation.
Right. I basically agree. I've been telling certain clients that there's right now, as we speak, I think we're roughly 35, maybe even 40% from the peak to the trough right now. And I've told a few clients, possibly we could touch 50% down from the peak. I think that's a little more pessimistic than you are currently. But I think 50, 52%, the United States is not going out of business. The country is not going bankrupt. So
Yeah,
there'll
I would
always be
agree.
a US. And, so I think possibly another 10% down from the lows we're seeing now in terms of peak to trough is possible. We might touch it. But I think that is a floor. What do you think?
Yeah, when we had the financial crisis, it was something like 1 out of 6 companies that got forced out of business, either through bankruptcy or liquidation. I really don't see it being this bad this time. I mean, it's pretty clear there will be some leisure companies that are forced into bankruptcy, some of which are used to operating in bankruptcy. We've had casinos and airline bankruptcies multiple times over the last 20 years. So some of the management teams that are in place with some of the better run companies are well acquainted with this process, and they know how to, work it to the best outcome. So I think we will see bankruptcies. I just don't think we will see them on the scale of what we saw in the financial crisis. And from that standpoint, I don't think really a market sell-off that's as deep as the financial crisis is really justified in this situation. It still may happen because of the fear index and the loss of liquidity in the markets, which we've seen multiple times, especially last week. But I think to the extent that we have some sort of V-shaped recovery or V-shaped sell-off and recovery, it indicates that it's really a liquidity issue significantly. And I think whenever you have that, you're magnifying the losses. So for that reason, it really does not make sense for people to try and protect the downside at this point. I think we are most of the way there on the sell-off, and if you sell now, you may regret it, because once liquidity comes back to the market, people are going to take a more rational look at what companies are worth, and investors may find that a lot of the company's current pricing is below where it should be for a temporary disruption.
You were telling me before we started doing this, you're out there in Reno and you're telling me about one of the hotel chains near you where the stock prices dropped 90%, 90%.
Yep. El Dorado Resorts, very well run company who has worked bankruptcy to its advantage. They've even got a deal right now with Caesars, where they have an option they bought a 50% interest in Caesars, and they have an option to acquire the full interest of Caesars, and they can also break off the deal. There's lots of options. I think the market, in assuming that shareholders are going to get wiped out at this point, I think may not know the real story, which I think is quite
right. And the point I'm simply making there is that example that you gave me is one example out of many in the economy where people, if I'm hearing you correctly, and I think I am, there's a lot of panic selling, but not based on thinking ahead 6 or 12 months. They're just looking at now and seeing the worst possible scenario rather than a more likely scenario. Is that what you're saying?
Yes, I think in past bear markets, almost every situation we were looking at was kind of a permanent situation where you didn't really know when the recovery was going to come, and people are applying that mentality to this sell-off. But this sell-off is fundamentally different in that it's a temporary disruption, and a lot of what we're seeing right now is going to revert in 3 months. So people are seeing, because of state mandates, hotels closing, casinos closing, restaurants closing, and assuming that maybe they're closed for good, and assuming that the sky is falling, when in fact, these people are being forced to close, or maybe the business levels are so low it doesn't make sense to take on staff right now. So they're just going along with temporary closures, and when this whole thing is over, then they just go back to what they were doing. So I think that's the difference this time. Is this is a very it's a very large disruption, but it's also a very temporary disruption in my
So
view.
in terms of Weber asset clients in particular, the ones who are nervous right now, and we've only had a very small number of people call us really nervous, wanting to cash out, move to something safer. Certainly, I tried to dissuade them, assuming they are in a risk level that is appropriate for them. Generally speaking, we want clients to stay where they are, because if we have assigned you to a risk level, that's the one that makes sense based on your entire financial situation, where you are now, where you're going to be in 3, 5, 10 years down the road. So you agree, Jack, I assume, that if we've done our job of putting them in the right risk level, they should stay where they are.
That's correct. Yeah, I think a crisis like this sometimes is a wake-up call for some people, because they realize that their risk tolerance is not as high as they thought. And so it's reasonable for some clients to make downward risk adjustments. This is not a great time to be doing that, but if it must be done, it must be done. And it should be viewed as a permanent situation, not something where you're going to lower your risk now and then raise your risk later, because that means you're just selling at the bottom and buying at the top. It's not the right thing to be doing.
It's why I wrote my book, Dear Investor, What the Hell Are You Doing? Because during the 2008-2009 crisis, we had a small number of clients who did exactly that. They sold near the bottom, and then they had the worst of both worlds. They locked in their losses and then didn't participate in the bounce when it eventually came.
Yes,
so we want to avoid that at all costs.
Correct. It's the classic bear market behavior, and in some ways amazes me that we still have to deal with it. You would think over time people would get smarter that way, but emotions tend to overrule logic at times like this.
But I will say, maybe clients have learned, maybe they read the book, maybe they've talked to you, but we've actually had very few panic phone calls. Very 2-3% maximum. So maybe they are learning the lesson. Maybe you and I can take some credit, and the whole general financial media is trying to tamp down the panic selling that could happen if cooler heads didn't prevail. Jack, let's talk a little more specifically about certain sectors of the market that you think you might move away from or might move into in the next 3 months, let's say.
Well, in a sell-off like this, I think generally speaking, the things that hit the hardest on the way down are also the things that tend to bounce back the strongest as well. And that's one of the reasons we haven't made any moves yet. But that said, I think there are some emerging opportunities. High yield bonds are often a good opportunity at a time like this, because they sometimes recover faster than stock market when people realize that things are going to be okay. And plus they're paying dividends during the recovery period. So it can make sense to perhaps emphasize high yield bonds a little bit more at a time like this.
And in your Weber portfolios, you do have a couple of funds that, investment grade bond, for example, is a fund you like. Is that what you're talking about right here?
Yeah, I think it's going to make sense to trim investment grade bond in favor of high yield or stocks, I think, because while the high quality bonds cushioned the downside, and we're now facing a recovery period where they may lose the rest of the way up. So, it makes sense to rebalance. It also makes sense to look at high yield, because high yield is likely to move in tandem with the stock market, so that you don't have a situation where you lose as much as you cushioned on the way down.
And in terms of the stock market, what do you think again is most vulnerable, and where do you think we might adjust or may see some of the Fidelity portfolio managers start to move in and maybe look for some bargains?
Well, there's a couple of thoughts there. I think it's possible that foreign economies get hit harder than the U.S. economy in this. And I think it's also possible that U.S. stocks will recover ahead of foreign stocks. So
I agree.
While holding,
by the way. Yeah.
Right. While holding some foreign exposure on the way down made sense because it helped cushion the blow, it might make sense to rotate into a more fully domestic position for the recovery. Likewise, there are some sectors that got hit unusually hard. The leisure industry strikes me as being pretty oversold at this point. it might make sense at some point to alter our sector positions and emphasize leisure stocks, because it might be a way to capture more opportunity on the way back up.
Right. All right, well, we want to wrap this up. Jack, I know you joined me in telling all our clients we have the financial issues that we try to take care of for you, but we have an unprecedented pandemic. It's not imaginary, it's real. And we talk to you, our clients, and we get to know you as people. And certainly everybody here at Weber and Jack Bowers, we all wish you and your family that you stay healthy, that you stay strong. We will be here manning the phones. We may do it from our houses, from our homes, but we're not forgetting about you. We're going to make sure that we're keeping an eye on what we're supposed to keep an eye on. So I'm Ken Weber on behalf of Jack Bowers and everybody here at our company. Stay strong. We'll be here for you. Take care. Bye-bye.
Okay, thank you.